All right, let's dig into IREN Limited. Now, this is a company that's been positioning itself as a major player in the AI and high-performance computing space, but today we're going to peel back the marketing layer and look at what the financial documents, the ones they're legally required to get right, actually tell us.
So this is the story you'll hear. A next-generation AI and high-performance computing company. It sounds impressive, right? It's forward-looking, but when you actually pull up their SEC filings, well, that's where the story starts to fall apart, and it falls apart pretty fast.
Okay, take a look at this. You really don't need a degree in finance to spot the issue here. This is their revenue for fiscal year 2024. That massive, overwhelming blue chunk, that's Bitcoin mining. And that sliver, that tiny little slice you can barely even see, yeah, that's their next-generation AI business.
So let's really get into the weeds with their AI company claim. The company officially reports revenue from two places, AI cloud services and Bitcoin mining. But as that chart just showed us, these two streams are not exactly created equal. Here are the hard numbers. Over $183 million from Bitcoin mining, and from AI, just about $3 million. I mean, come on, that's not just a different story. It's the opposite story of what they're telling people. Calling this an AI company is, well, it's a bit of a joke.
So, if the AI business isn't really bringing in the cash, how are they funding their operations in this big expansion story? Let's follow the money, because this is where it gets really important for anyone thinking about investing. They're heavily relying on something called an at-the-market offering, or ATM. Basically, think of it as a corporate cash machine. It allows the company to create new shares out of thin air and sell them directly on the stock market whenever they need a cash infusion.
And this isn't some deep, dark secret we had to uncover. Nope, it is stated right there in their public filings. This phrase is the key. This is a core part of their financial strategy.
So you might be thinking, what's the big deal? The company gets the money it needs to grow. Sounds great for them, right? But for the people who already own shares, it's a completely different story.
In one word, it means dilution. Imagine you own a slice of a pizza. Every time the company uses this ATM, they're not making your slice bigger. They're just adding more and more slices to the whole pizza. Your ownership stake, your piece of the pie, just gets smaller and smaller every time they do this.
Now, you'd hope that a publicly traded company, especially one raising all this money, would have its financial house in perfect order. But as we kept digging, we found a pretty big crack in the foundation.
And here it is. This is a quote directly from their filing. Management found a material weakness in their internal controls. Now, let me be clear. In the accounting world, that phrase is a blaring five-alarm fire. It's a direct admission that their system for managing and reporting their own money is fundamentally flawed.
And if you thought that was bad, it gets worse. This is the knockout punch. They actually state that their own audited financial statements should no longer be relied upon. They are literally telling the public, hey, you know those numbers we published? Yeah, don't trust them. It's shocking.
And here is a perfect example of why. Look at this restatement. They initially reported a positive cash flow from operations of over $52 million. Pretty good, right? Well, after they had to go back and fix their material weakness, that number swung to a negative $130 million. That's a $183 million difference. It completely changes the financial picture from a company generating cash to a company burning it.
Okay, let's step back and put all these pieces together. We've gone through the marketing, the revenue, the financing, and the accounting. So what's the final takeaway from this forensic deep dive?
So here's the summary of the risks. You have a massive disconnect between the company's story and its actual revenue. You have a funding strategy that can continuously dilute the value for existing shareholders. And to top it all off, you have a formal admission that their financial controls were broken, forcing them to retract their own numbers. It's just a whole collection of red flags.
Which brings us to the final and most important question. When a company's marketing story and its legally required financial filings tell you two completely different things, which one do you believe? The story is just a story. The filings, well, that's the reality. We'll leave you to think about that.